Hi, I'm Christina Bui with Crayons. We are the preeminent accounting and financial solutions firm helping startups and venture capital companies grow. Thank you for joining us for today's webinar, Practical Aspects of Transfer Pricing, Pricing and Contracts. During the presentation, all participants will be in a listen-only mode. You can submit a question at any time throughout the webinar by clicking the Q&A button at the bottom of your screen. As a reminder, this presentation is being recorded for replay purposes. A link to the recording and the slides will be emailed to you within a few business days. In order to obtain the CPE credit for this event, you must answer all 3 polling questions throughout the session and complete the post-event survey. Qualified attendees will receive their CPE certificate in 4 to 5 weeks. And with that, we'll turn it over to our partners at Baker Tilly.
Great, thank you very much. Good afternoon, everyone. And as Christina mentioned, thank you for spending a small portion of your afternoon with us. My name is Rubina Jafari, and I am an international tax partner with Baker Tilly. Additionally, I serve as the firm leader for our transfer pricing practice. Our transfer pricing team specializes in developing and implementing concise transfer pricing methodologies for very large Fortune 500 companies, as well as early stage and high growth technology startups. As such, it's my pleasure to introduce my colleagues, Matthew Damone. Matthew will spend the next 50 minutes or so providing a candid view of what transfer pricing is, the regulatory framework that it surrounds, and how this framework can be aligned to your business. And with that, I'll hand over the conversation to Matthew.
Hi all, thank you. As Rubina mentioned, it's my pleasure to speak to you today. My name is Matt Damone, a transfer pricing director with Baker Tilly. I spent upwards of 15 years advising and implementing transfer pricing for multinational firms across many industries. I work closely with Varangana Punchaheva, who is the co-director within our specialty practice. As we progress through the material today, please feel free to engage in the conversation via the chat function. We'll be actively monitoring questions. We'll incorporate most in our presentation today if possible. And with that, let's start the presentation and start to dig into, what is transfer pricing? What we're going to be looking at today are primarily 3 things. We're going to discuss and understand, what transfer pricing really means. Is it, actual prices? Is it this regulatory framework that, the New York Times puts in quotation marks all the time because it's scary? But we're going to talk about what that means. We're also going to discuss some of that evolving regulatory framework. So, new laws are coming out every year, new regulations, new interpretations of existing regulations. So we'll touch on a little bit of that. And that both of those items are really to set the framework for the last bullet here. And what we want to do is talk about how we can determine strategies to align your business and the business operations with transfer pricing regulations. That's really our primary focus here and what we want to do. Perfect. We're going to start off getting one of these polling questions out of the way right away. Really, we want to know here, what is your experience with transfer pricing? These are all relevant, but I think it'll help kind of guide some of the discussions I'm going to have today and the way I can explain things to get a good understanding. Give it a couple more seconds. And here, be honest and we'll work through some of this, right? If we have any experts on here, please ask some good questions, right? That'd be really helpful. Let's see, hopefully it's the beginning. Do you want to, maybe we can end that question and kind of see the poll results? Is there a way to kind of show those poll results? Perfect. Perfect. This is kind of what I figured. And this is kind of a nice mix. So this is great. I don't know if there's too many people that answer. Do we want to maybe leave it open a little bit so everyone can we can come back to some of those CPEs? I'm not sure if that's possible, but. All right, let's move on to get started. Perfect. So what is transfer pricing? And broadly, you know, I think of it, and, you know, regulatory bodies think of it as, you know, any transaction between related parties. This is going to include tangible goods, services, you know, intercompany cost allocations, which oftentimes aren't, you know, companies don't consider transfer pricing, intercompany debt and loans, asset transfers. And, you know, one of the biggest ones, and maybe one we'll focus on a little bit today, just because of, you know, the mix of, you know, people intending, are intangible assets. And what is an actual intangible asset transfer, whether it's use of an intangible, whether it's the actual sale or transfer of an intangible. But, you know, we want to focus on the fact that all of these types of transactions are considered transfer pricing. And not only should they be managed from a regulatory standpoint, but as a best practice, you know, we should all, you know, plan for them and use them, you know, to our benefit to make sure that we're optimizing our, you know, transfer pricing models, right? As practitioners and as taxpayers, you know, we can use some of these tools and regulations and models to benefit the business itself, right? And really make sure that we're achieving needs. You know, almost all jurisdictions adhere to some form of arm's length standard. Everyone talks about Brazil. Brazil's the main country that's sort of outside of that, that, you know, framework. They use more of a formulary apportionment. But the point here is that when we're having transactions, or if you have subsidiaries, or even, you know, if we get into, even if you have contractors, right, just working in various jurisdictions, almost every single one of those jurisdictions is going to look for some interpretation of the arm's length standard, right? One point that I really want to make clear, and I think is a good thing to understand, especially, you know, for the framework of how we're talking, but even when you're trying to explain transfer pricing, you know, within your business, you know, or to other stakeholders, is this idea of operational transfer pricing versus kind of regulatory transfer pricing. Operational transfer pricing might be, you know, the plus that you put on a set of costs when you charge them from one entity to another. That might not necessarily be a way that you want to defend it to a regulatory body. That might not be the way that you want to tell a tax authority, you know, that your transfer pricing is arm's length. The operational transfer price is how you get to the specific numbers. The regulatory transfer price is going to be, you know, how do we test it? How do we prove that it's arm's length? How do we work with it in a regulatory framework, right? Oh, and I see Maddie put something up there for one of the questions. I'll just say that anyone who maybe doesn't have that chat open, we can talk about, if you miss one of the questions for CPE, don't worry about it, come back. We can answer some of those questions for you, put them in, and make sure that you guys were here. So don't let that, you know, stop anything. The last point that I want to talk about here is really, you know, the global regulations, you know, it's exactly like I wrote it. They provide the framework and methods to test the arm's length nature of the results of transfer pricing. This works hand in hand with the operational transfer pricing versus kind of the regulatory version. And, you know, we need to be cognizant of variations in certain jurisdictions so that our operational transfer prices that may be defendable using even just that basic method in one jurisdiction, you know, that might not be defendable on the other end of that transaction, right? We always want to take into consideration kind of both sides, you know, of the coin, so that, you know, we don't leave ourselves exposed in one, you know, jurisdiction versus another, right? Maybe we can go to the next slide. Okay. What is that regulatory framework? And I'm not going to spend a lot of time on this talking about, you know, specific regulations or anything like that, but, you know, the primary regulatory framework for US multinationals should first and foremost be, you know, the US Treasury regulations under 482. Those regulations, along with, you know, interpretations and court decisions, you know, provide kind of a global framework from a US perspective. The OECD transfer pricing guidelines, are, I don't want to say that they're, extremely similar to the US regulations, but in practical purposes and, in the application of the methodologies, the US regulations and the OECD regulations align 90% of the time from a technical standpoint. There are certain regulatory requirements in terms of documentation, in terms of information disclosures that might vary from jurisdiction to jurisdiction. But if we're talking the economics of transfer pricing and how they will influence your business operations, US Treas regs and the OECD guidelines are, you can plan for one and it'll hit both, right? I put this third bullet here, this anti-base erosion and profit shifting initiative, which is called BEPS, kind of colloquially throughout the industry. You're going to hear it a lot. And if I start to, if you hear me rattle off BEPS as an example later, it's really, this is what we're talking about. These initiatives were spearheaded by the OECD, and essentially they're 13 and moving into 14 initiatives that are recommendations for tax authorities around the world and sample guidelines to minimize the amount of profit shifting and essentially transfer pricing for manipulative purposes. There's also financial services transactions, there's international tax, there's PE, there's many topics under BEPS. We're going to focus primarily on the transfer pricing ones here. I wonder if you have, just some thoughts on this as well, kind of either from a regulatory framework or what you see, when describing some of the transfer pricing, like what is transfer pricing?
Sure. I had 2 comments, Matt, but sticking to what you just talked about for BEPS and connecting it to the kind of having to make sure both sides are covered, where I feel before BEPS came in, that some clients were able to do that, where there was no real sharing of information. And it's not, I don't know, Matt, if you feel that it's strictly followed, but there are countries that are now sharing information where we have to almost have both sides of the story straight. Whereas back in the day, I know I've done studies where we've done it in, from one perspective for one side and another perspective from the other side, which we cannot do anymore. So that just wanted to say, because of BEPS, you even have to be more careful just in terms of how we say both sides of the story.
Yeah. I agree with that. And that's a really good point. I think, a lot of the regulations and the new, information disclosures, their aim isn't to change the rules. Their aim is to change the amount of information that is available to regulatory bodies, as opposed to taxpayers holding all the cards, right? So, what that means kind of in a business sense is that you might have, intercompany agreements in place. You might have what you feel is the right amount of information to make arm's length determinations of pricing, especially if you're in a market where you are contracting or dealing with third parties on a constant basis. These requirements just make sure that everyone's on the same playing field and really list out what needs to be, documented and what needs to be kind of provided when asked, so that tax authorities can see, the reasoning behind the methodologies that you're putting forth, right? The last thing I have on here is just court cases, right? I think we all know that as good providers, we can read the regulations and understand kind of the black letter of the law and the regulations, or even their intent. But, we need to be able to understand that, regulations are created to be interpreted, right? And until a court rules that one interpretation is correct versus another, that means that regulation is still open to interpretation. This happens all the time, and we consistently see tax authorities kind of overstep their, overstep the intent or overstep the authority provided to them in the regulations, and courts, kind of walking that back, right? Maybe every time a regulation changes, it might be tried to be applied retroactively. The tax courts or even appellate courts will step in and kind of walk that authority back from, the tax regulators. So, using this kind of framework, which are very broad regulations, initiatives that are coming online, some of which are made public, some of which are kind of buried. And then looking at how the courts in every jurisdiction are interpreting those regulations, that's kind of the, malleable framework that we exist in. And as practitioners, the better ones, we understand that that's a gray area, and that for taxpayers such as yourself, when you're trying to manage this, sometimes it can be frustrating, right? You say, well, what's the rule? What should I be doing to just be compliant? And then people come back and say, well, there is no actual black and white rule. It's facts and circumstance based, and it depends, right? We all understand that that's frustrating, but I think with good guidance and really sticking to some real best practices, which we'll talk about later, it can be pretty easy to navigate, right? And still provide, I think, some of that business, business needs and business optimization, through transfer pricing. Can we go to the next slide? Perfect. We touched on a little bit about this, basically talking about that open information sharing. I think that is the #1 driver of transfer pricing regulations that have been actually enacted, not in draft form, over the last few years. Items such as the MAP and competent authority procedure clarification. For anyone who doesn't know, basically that works with the international tax treaties to avoid double taxation, right? And it basically is a reiteration of the cooperation that country jurisdictions need to have. It's fine, every country acts somewhat autonomously in the way they implement tax regulations, but it's very, very important to understand that there are mechanisms and binding mechanisms and binding arbitration to ensure that double taxation doesn't exist, right? Just because one tax authority doesn't agree with your interpretation of the regs and maybe applies a transfer pricing adjustment, usually we can get some type of relief, from the other tax jurisdiction, that would be party, right, to the adjustment. The digital economy initiatives, you might hear a lot about this if you know where to pay attention. And I think with kind of the mix of the individuals we have on the phone today, this one might be, specifically kind of important. Tax regulations are very slow to change. They are not very, they don't respond to the times as quickly as we would like them. And so we do have a situation now where a good portion of our economy is based on, digital initiatives, whether it be advertising from, sales revenue, whether it's streaming services, whether it's, a SaaS model where you might be licensing your software to customers all over the world. The OECD and member countries are trying to create a unified approach to have a consistent application of taxation for digital initiatives. It's still working through, it's still in draft, but I will also say right now it's aimed at kind of the top tier technology companies in the world with revenue in the billions. But if experience teaches us anything, it's that these regulations will trickle down and have an impact, right, on startups, an impact on mid-sized businesses, and an impact on businesses that might not quite reach that 10 billion a year or even $1 billion a year in global revenue, but these regulations tend to apply to everyone eventually. So that's just another thing to kind of think about. We already talked about global cooperation. So yep, polling question 2, get the second one out of the way right away, right? This is, I'm not even asking if you have transfer pricing documentation, right? I think today I want to get away from the idea of transfer pricing documentation, which usually looks backwards, right? It's looking at the year that happened and you're trying to prove that your results were arm's length. what I want to discuss today and what I think we're going to move on to and kind of spend the rest of the hour on is what, what models can we put in place currently to look to the future? And, is that something that, the folks here on the phone are actively tracking, actively monitoring, and actively have thought about and put in place so that the answer before the end of the year, right? That's what we're really asking here. Maybe give it another 10 seconds and then maybe close that out. And can we, good. That's great. Right, and so, about a 60-40 split. And that's similar to what I see kind of in industry, right? I think it's, the ones that are, no, or we try or not sure, right? Obviously, I think, that's a situation where we can, you can try and do a little bit more to shore that up, right? And I think in doing so, do it again prospectively, right? To make, start with business needs and then work backwards, right? Into kind of documenting and making sure that, it's working for you. For the folks who said yes, and you can take that down and we'll move to the next one. For the ones that say yes, that's great, right? I think, making sure that that's in place has a lot of benefits, especially, we'll talk soon. What I always say is, every few years, there's no reason that it can't be revisited, right? If it's not necessarily driving the results that you want, let's take a minute to think about it and to then go back first. What are our business goals and business objectives? And then how can we meet that through transfer pricing, within the regulations, within, the realistic alternatives of your business. But every few years, especially with, recent tax changes and how it's ever evolving, it makes sense to take a look every now and then. Okay. We spent about 20 minutes on, kind of what is transfer pricing. Let's talk about, aligning it with your business and trying to make, some of these regulations work in your favor, trying to make, the business flow a little easier, right? And trying to be able to plan for the results, right? But this first line is really, this is true, and everyone says this, the tail shouldn't wag the dog and tax shouldn't be your primary concern. I wholeheartedly agree with that, right? And your actual business should dictate your transfer pricing model. We might have a few models available based on your needs, but we can only do that within the framework of what's actually going to work from a business perspective. These other bullet points are basically just examples of the types of questions we would take into consideration and what you should take into consideration, when trying to implement something, a top-down management or more independent. This question often comes up when we see companies that are very acquisitive, right? If you have a US multinational and you're kind of bolting on pieces, through acquisition on a global basis, those entities might, they might be fully functioning and fully operational businesses that need very little from the US parent, maybe some headquarter costs, maybe some, efficiencies or services. That would be one indication of a type of model that we'd want to put in place. If, however, you're, a US company and you want to spearhead an effort into expanding into Asia or Europe, and you create a local sales office fully under the direction of the US business, right? That's another set of facts that would likely change or influence what type of transfer pricing model, we would want to put in place, or what you would want to put in place to kind of realize those benefits. Excuse me. This second bullet point is extremely important, and I think sometimes overlooked, especially when there seems to be a simple answer, right? Everyone assumes, hey, let's just make it cost plus 5, right? That's the default thing for transfer pricing. What's transfer pricing? Cost plus 5. Cost plus 5 might be right, Well, let's think about it first and understand how we're implementing it to make sure it's driving the results. And the biggest question there would be, what entity in your business should assume entrepreneurial risk, right? Which entity in the business do you want, residual profits to be earned in, right? Again, let's go back to that multinational opening up a European sales office to kind of be a spearhead into global expansion. If they start to do very successful and start to really earn a lot of contracts, or you start signing up customers locally, does that mean that they should earn the residual profit? Should they earn the entire bucket of profit when they only have sales costs? No, right? IP is developed in the US in this example, strategic management is here. So we need to figure out a way to kind of make sure that the right entity is being remunerated and getting paid for not only the functions they perform and the IP that they own and develop, but the entrepreneurial risk of even starting and running the business, right? I mentioned functions, right? Here, when we talk about what function, right, are they actually doing? This is the substance question. This is a question that as a practitioner over the last, 15, 16, 17 years or so, I've seen this evolve from the idea of substance being, two people jumping on a plane and having a layover in Bermuda where they conduct some meeting minutes and suddenly they argue that that is substance and therefore Bermuda goes work. I've seen kind of the pendulum swing, especially through BEPS, and talking about, really looking at, does each entity or each business have the substance in the legal entity that they're claiming is driving the functions to perform what they're doing, which would, entitle them to that profit. BEPS talks about delineating the functions, right? Which means describing the actual supply chain, whether it's a services supply chain, a transfer pricing supply chain, or even, if it is a tangible good, that's a little easier. But really understanding and talking about what that means so that we can delineate the transactions and then apply profit appropriately to each business, right? Once you delineate those transactions though, how do you rank them, right? And so we ask ourselves, who performs these high value functions in the group, right? Who performs limited functions? I can tell you right now that the highest function that profit will usually flow back to, is the creation, management, and exploitation, right, of intellectual property, right? They're called DEMPE functions: development, enhancement, management, protection, and exploitation of intangible assets. And whatever entity is doing the most of those is usually the entity in the group where the profit is going to attribute to, right? That's just a good, kind of a good rule of thumb, right? Virangana, do you have, thoughts on kind of these, differentiators and maybe other thoughts that can be considered, right, when we're thinking about these types of questions?
Yeah, I guess one example of a client that we're actually we've been working on since last year, and it came up through due diligence, which I'll touch on if it makes sense later when we talk about due diligence. But this client, just like you said, Matt, is an acquisitive client where they ended up acquiring one of the third parties that they were working with, and now that entity in Germany became a related party. This is a U.S. parent, and without giving it much thought, they continued the royalty arrangement that they had, and a few years later, they realized they're accumulating a lot of profits in Germany by doing that, whereas all these activities that you talked about, the DEMPE functions were in the US, where at the end of the day, they should have left a routine return in Germany and brought back the rest of the profit where they actually needed it. So we're working through that, but that's why it's important that even though they felt that it was, it's the same company, we're just going to be doing the same thing, but there was a significant shift in the functions and the operations, and therefore they may lose some in the prior years because there may not be much we can do for the prior years, but at least going forward we are reassessing and changing that transaction structure.
That's a great example, right? Because, and maybe we can move to the next slide real quick. Perfect. So that's a great example because it gives us the opportunity to kind of look at the difference between a principal operating model and a transactional model. So when you're dealing with an entity when you're dealing with a third party that you may acquire or bring on board, there are transfer pricing methods available to you, basically called comparable uncontrolled price or comparable uncontrolled transactions. And what those rules allow you to do is say, these are the exact prices we were paying to third parties for the same business. And we would, so if we acquire, a development house, maybe, and, you're using an offshore developer, they're third party, you're paying them a certain amount each year, maybe it's even profits based, or maybe you're licensing some technology that they have to incorporate into yours. Taxpayers often automatically assume, hey, I can just keep paying the same amount, right? And that is an example of an arm's length price that would work from a regulatory standpoint if everything else, was so inclined to kind of line up. But it might not be the best situation for the business. You've acquired this small company, they have IP that's valuable to you that you want to use. You want them to keep developing and doing the good work that they've done. But now that you've taken on maybe that global entrepreneurial risk, you're providing strategic management, right? You might want to think about, how do we change the transfer pricing to align the intercompany transactions and then the profit with our global business? And that's the difference between kind of a principal or a transactional model. A principal operating model basically takes the global entrepreneurial risk, the economic ownership of intellectual property, and usually centralized management and oversight, and puts it into one entity, right? We often hear principal operating models in conjunction with some of the more aggressive transfer pricing and tax structuring and work that had been done in the past. Think of, an Irish IP principal, that receives intellectual property royalties, from a global perspective at a tax, at a lower tax rate, right? That's true. That's one example, of an efficient principal model created in, certain environments where that was the norm. But a principal operating model also works if you're just a US multinational with a US headquarter company, right? There doesn't need to be any, kind of tricky interpretation of transfer pricing rules. You don't have to put transfer pricing in, air quotes or actual quotes when describing it in a newspaper article. We can basically say that with the US as the, principal company in a structure with either foreign sales affiliates, foreign development, foreign, sourcing or shipping, we can use the US principal company to pull cash back to the US, to make sure that the residual profits flow back to the US and are really then able to be used, by the company that is, doing the majority of the high value functions, right? It gives us the opportunity to limit the amount of, offshore taxation in an appropriate way so that they're getting what aligns with their functions, right? What aligns with those entities' risks, and no more and no less, right? Now, that has certain benefits that we kind of just talked about. That's good for, companies that are growing and expanding, companies that want to, utilize, that capital or utilize cash and deploy it from a centralized position. The other model, and what, Virangana was kind of mentioning there, is a transactional model. In this case, right, we can use every single transaction and look at that individually, right, to prove under regulations that those transactions are arm's length. So in Virangana's example, that royalty that they were paying is likely to be upheld as arm's length. Did it give that new affiliate maybe a little more profit than was anticipated? Yeah, in this model, they probably would have been better served under a principal operating model. But under a transactional model, it gives certain unique, benefits as well. So if, we see this a lot in offshore companies investing in creating US companies. So if we have an offshore IP holder, they're creating a US business, which will utilize the IP and kind of try and expand into the US market to monetize that IP. They might look for a transactional model because they have an interest in showing the US entity becoming, ever profitable, driving profits, driving value, keeping that in the US. Whether that's, because it makes sense from an investment standpoint where they might have other individuals coming in to, invest from a US market and they want to see that, as potentially profitable. And we'll talk about it in a little bit, or maybe this is where, they're trying to sell off a portion of the, of the business. And if you're looking to have someone come in and acquire, right, the US portion of a business with an offshore IP holder, it's in your best interest to make sure that you have the transfer pricing right, but that you're showing how successful, maybe that US business can be utilizing the IP, right? Again, this is the business and the business needs kind of trumping the, pure regulatory framework or just using the simplest method, to prove that it's arm's length. Can we go to the next slide? All right. So we talk about, those business needs. We talk about, what are some of those benefits? I know that there are some people, there always is, and it's a smart, high level, understanding. And some of the people just say this all consolidates, right? I don't care about transfer pricing because I look at my business on a global basis, and on that global basis, intercompany transactions melt away, and we look at everything, as one. Fine, right? That's one way to look at it, right? It's not a wrong way, but I think that there's a better way. And one, tax compliance, I'm not going to get bogged up on that, right? I think everyone knows that there's certain tax compliance issues. If you are running losses in a foreign jurisdiction consistently, or if you're an inbound company and you're a US company, your US company is consistently running losses, that's going to cause attention. That's going to be relatively difficult to defend on exam. And it's likely that, adjustment would be put in place, right? I mean, that's just, unless you're operating a really locked down, kind of transactional model where you really manage and prove every transaction out. If you're running losses on a relatively simplistic entity and not the principal or not the parent company, you're probably going to have some issues. So from a tax compliance matter, it's important, especially if it's material. If it's not material, right, from a tax perspective or a risk perspective, it may be material from a future state perspective. In Vrangena's example, that German continued development of intellectual property while acting as an entrepreneur will build up the value of that intellectual property from a tax perspective and an economic perspective. Even if the legal side of it does not align, if the contracts can say the US owns that IP, if it's consistently developed in Germany and it's paid for with a royalty and the German entity is, acting entrepreneurially, the German tax authorities are going to assume 100% that they own the economic value of that intangible property. That might go against your business, right? Or your business purposes. That might be something that you do not want to happen based on future sales of the entity, or how it will, dictate your future transaction flows for any other type of transfer pricing as you expand. I'll stop. Vrangena, do you have like an example here or just anything to add right here?
I was trying to use, I moved a little bit ahead with the due diligence, Matt, but this same client is a very good example of all of what you're saying, is that this came up in due diligence where they had some escrow holdback because of kind of going back to your tax compliance. They were they were meeting the requirements, but what they missed is that they were actually overpaying in Germany in this case, where it actually needed to be a principal structure versus they weren't really the entrepreneur. So so yeah, it's they were compliant from just a compliance purpose, but they weren't efficient, and it came up during due diligence where they felt that there was too much payment and therefore exposure from a U.S.
Right.
perspective.
Right.
So yeah, I was trying to combine. It's a very good example of all these things that you talked about.
So, right, and when I bring up due diligence concerns, and Varangana kind of touched on it as well. I mean, every year, maybe even every month at this point in this environment, right? I'm either defending a transfer pricing structure that we've put in place, or doing due diligence on an acquisition for one of my clients who's, looking at a prospect. And transfer pricing can hold up due diligence like almost no other tax issue can, mainly because it's gray and it's unclear, right? And if you're buying a company that is primarily being valued on its intellectual property, where that intellectual property is created and where the economic ownership from a tax perspective, where that ownership lies, and what would be some potential tax consequences of trying to move that or sell it, are extremely material, right? And oftentimes paramount to the valuation or to, the due diligence deal. So, I've seen deals fall apart because of transfer pricing. I've seen that same client come back with a fully realized, and documented and succinct transfer pricing model, and the same firm doing the due diligence for, a new potential acquirer. So this is great, and walked away, right? It went from a major issue that ruined one deal to the same firm, another big four firm coming back and saying, okay, like we sign off, this makes total sense. We understand this and we get it. So, don't think of this as just, some tax guys, raising hell, right? This really can have real concerns, and it can be a benefit. We only have about, 10 more minutes left. Let's go to the next slide. And this will be kind of the last slide that we touch on. But I want to talk about, how we can take those considerations that we've discussed and kind of turn them into best practices, right? And what we need to do is, when I say analyze it from a global approach, that really means all of the leadership in your business being involved and understanding what transfer pricing is, the benefits that it can bring to the company, and the risks, that it can also present to the company, right? And so what we want to do is kind of get that message across that when we see, intercompany transactions that exist, oftentimes leadership at the highest levels needs to be involved in a change if there's going to be a change. If there are additional transactions that should be implemented, maybe a royalty is appropriate. Maybe there's a management fee that should be pushed down, right, to other affiliates to bring back cash to the U.S., where one of those transactions doesn't exist right now. This kind of right sizing of financials through transfer pricing modeling will impact the financial results of each legal entity and each business. And it's much more effective. It's a lot easier to implement and a lot easier to manage when leadership looks at it from a global approach and is on board, right? If there's anyone on here that's a tax director fighting the uphill battle to make your transfer pricing work, and you have a controller, or the rest of the business says, do that below the line, or don't talk to me, we run the business the way we run the business. We want to see, you get the tax compliant correct. I feel for those situations, we deal with them, right? And we can always make that work. But, the really truly effective and impactful models using transfer pricing have that, global approach. I've harped on this a couple times. Figure out what your most important business need is from transfer pricing. Is it a lower cost development team in a foreign jurisdiction? Great. We can work with transfer pricing to make sure you're compliant. right? And to make sure that, they're getting paid enough, but from an economic perspective, the IP is still held in the US, right? Whether or not the legal framework is in place or not, it can be an economic and tax question. If you have, multiple foreign jurisdictions that are just knocking it out of the park, and there's so much growth and they have so much trapped cash, right? What are the opportunities besides just, creating a dividend and sending it back or trying to loan it back? There might be transfer pricing transactions that might align you more with the regulations that make you more compliant, that still allow you to bring some of that cash back, right? Without, potentially without withholding, right? Without, certain considerations or paying tax on it first before it comes back on a dividend, right? Let's create some sort of transfer pricing model where those charges are deductible. You're lowering your tax costs in that country and you're bringing cash back to where you need it. This third bullet, and again, I'm not harping on transfer pricing documentation like 66, 62 compliant transfer pricing documentation to the point where you're looking back and testing all the results. That's important, right? I think if you have a position that might not be so, open and shut or black and white, documenting does give you penalty protection. It's good to have that formal testing documentation. However, much more important to me is, having a document, or what people call it a planning study, right? But it's a document that describes the methodology for how you are going to implement transfer pricing, showing the intent of allocating the risk, the functions, and the assets to the entities that you want to, based on business purpose, right? So when you make transfer pricing adjustments at year end, tax authorities don't think you're cherry picking or trying to strip income from an overly profitable entity. No, you have this policy in place. You have an analysis that supports the arm's length nature of that policy. Everything is in place. When you're doing budgeting, right? Strategic leadership in your group can say, well, we might be earning $5 million in new sales from our new UK startup entity, but we know that we're only going to have 3% profit on that because the remainder is going to come back to the US through forms of transfer pricing, right? So if we budget for sales, we then know how much profit's going to be there. You can estimate how much cash will be there, how much tax will be paid, right? And so these tools then allow you to look forward with accuracy on a legal entity by legal entity basis, and even a transaction by transaction basis. And that last point, right, is to just periodically review, right, the model to make sure it's achieving those goals. One area where it almost never achieves goals is transfer pricing, especially when it was more aggressively implemented a few years ago, always planned for profit, right? If you have a low tax jurisdiction and you're sending IP royalties to them, you're planning on profit, right? Otherwise, you're going to be paying, tax in some of the high jurisdictions and take the losses in the low. That happens all the time. You don't hear about them in the news because those businesses, they fail. They're not avoiding taxes, they're paying too much, and then they fail. But what I mean by this is review that model. For the 40% of you who have it in place, is it doing what you need it to do? And if it's not, let's take another look, right? Let's think about it again, maybe more simplistically, maybe more, creatively, right? But, I know we have about 10 minutes. We hit the 50 minutes for CPE. So let's get to that last question, right? Here we go. So do you actively manage transfer prices to a desired outcome? Again, for the people who have a model in place already, this will be a good indicator. Are you using that model to get to a result, or are you using a transfer pricing model to just document what happened? Like, oh, good, like the results are okay, we can document it, and I think we can be defensible. In the meantime, I don't know, I'm not sure where questions might come up, but if there's, questions that have come through or any comments, Varangan, I don't know if you see them. I see a few things on the chat on the side, but it's just, it's really just some the CPE stuff.
I don't see any, Matt.
Okay.
Rabina and Christina, I don't know if there's anything on your end?
So I'll also say, this transfer pricing it's very gray. It's a little esoteric in determining what the answer should be. The fact that you might not want to share a question with an entire group, understandable, right? Anyone on, the Baker Tilly side here, is happy to answer questions, one-offs, general, broad, whatever we need to kind of, whatever we need to do to get you the info, that you need and to actually think about it, correctly. Do you want to, can we stop that and look at right? So about, 15%, 16%, we're managing to a result. Again, that's smart. I think, for the others, we can put something in place, right? I mean, I think you guys should think about that and say, what is that objective? And it doesn't need to be a TP result. You can be creative with your result and what you want your objective to be, and then we can manage to it, right? I think that's the end goal, right? That's all I had, right? So thank you everyone for coming. Rubina, would you like to take us off?
Yeah, sure. Thank you, Matt and Veronica, for your insight and presentation. Everyone, as mentioned earlier, a recording of today's presentation and the associated slide deck will be available for replay purposes or as a special treat for your friends and colleagues. A final reminder before we adjourn, in order to secure CPE credits for participating in today's webinar, please ensure to complete the evaluation form that will appear upon your exit out of this Zoom session. You will receive credit in about 4 to 5 weeks. On behalf of your friends at Kranz and Baker Tilly, thank you for joining us. Have a pleasant afternoon and take care. Bye-bye.